Imagine spending like 30 years building a 78 million rand business empire.
Mm-hmm.
You know, you sacrifice your evenings, your weekends, you pour literally every ounce of energy into this entity.
Your whole life.
Exactly. And then suddenly you pass away.
Mm-hmm.
And instead of inheriting this financial fortress, your family is just completely locked out of the bank accounts.
It's devastating.
They are forced to borrow money just to pay for your funeral, and they have to stand by and watch your thriving company get sold off for scrap.
Yeah.
And it's all because you made one foundational legal mistake while you were still alive. So, welcome to the Deep Dive.
Glad to be here.
Today, we're looking at a concept that is going to fundamentally change how you view, well, everything you own. We're talking about building an asset protection fortress.
Which is arguably, the most vital topic for anyone generating wealth. But strangely, it is the one area that most successful entrepreneurs completely neglect. We spend our entire life hyper-focused on wealth creation, but we allocate almost zero mental energy to wealth protection or like how that wealth will transition when we actually step out of the picture.
It's so true. So today we are drawing from a phenomenal guide called The Fortress of Legacy and also the direct insights of Lumka Sturman.
Right. She's great.
Yeah. She is a highly respected South African trust consultant
Okay.
and an asset protection specialist. And I should say, our mission here isn't to just dwell on the doom and gloom.
No, not at all.
We're going to explore the incredibly positive, like literally life-saving benefits of having a trust in South Africa. We want to show you how it transforms a potential family disaster into seamless generational continuity.
So to set the stage for you, we really have to dismantle a massive misconception right out of the gate.
Okay, let's do it.
There is this pervasive idea that a trust is exclusively for the ultra-wealthy,
Right, like billionaires.
Exactly. We picture massive estates, old money families. But at its core, if we connect this to the bigger picture, a trust is simply a legal arrangement that separates ownership from liability.
Interesting.
Yeah, it is a critical foundational tool for any entrepreneur, contractor, or high-earning professional in South Africa. It's the mechanism you use to separate your personal human risk from your hard-earned assets.
Okay, I want to look at what actually happens without that separation. Because the sources paint this really stark contrast of chaos versus continuity.
They do.
They use this striking cautionary tale, the story of Richard Thompson.
Oh, right. The Thompson case.
Yeah. Richard was 58 years old, highly successful. He'd built this electrical contracting business with 85 employees, pulling in 45 million rand in annual revenue.
Wow.
He owned commercial premises, a solid investment portfolio, beautiful family home. His total estate value was 78 million rand. So by all societal measures, he was totally sorted.
On paper, yeah.
Right. But when he died suddenly of a heart attack, the system didn't care about his success. It triggered what the sources call the immediate freeze.
And that freeze is an absolute, uncompromising legal mechanism. Because Richard owned everything in his personal name, the moment his death was registered with Home Affairs, his entire estate was locked by law.
Locked down completely.
Completely. The business accounts required his signature for anything over 50,000 rand, so instantly nobody could authorize payments.
And the timeline here is just terrifying. Payroll was due in 10 days. His accountant couldn't legally touch the money to pay those 85 staff members.
The domino effect there is brutal, and it's rapid. The bank looks at the situation, they see the sole signatory is gone, and they realize their risk profile has completely altered.
Obviously.
Yeah. So within 3 weeks, the bank called in the company's overdraft facility.
Oh, wow.
And without that working capital, work on major commercial contracts simply halted. You can imagine the fallout, right? Key employees panic. They jumped ship to competitors because they needed to feed their families.
Yeah. I mean, you can't blame them.
Clients canceled contracts, and while this business is actively bleeding out, the family is stuck waiting on a completely overwhelmed bureaucratic system. The Master of the High Court took 11 weeks just to issue letters of executorship.
11 weeks.
That is 11 weeks before anyone could legally even start untangling the mess.
Let that sink in. 11 weeks of total paralysis. Meanwhile, his widow, Margaret, she has zero access to his personal accounts to even buy groceries or pay the electricity bill at the family home.
It's tragic.
She actually had to borrow money from her brother just to survive the immediate aftermath of her own husband's death. But wait, I'm putting myself in the listener's shoes here.
Okay.
Surely a basic will's enough to stop this kind of total meltdown. We're all taught from day one, just get a will and your family will be fine.
A will is a crucial document, definitely, but it does absolutely nothing to prevent the freeze.
Wait, really?
Really.
Yeah.
A will simply acts as a set of instructions for the executor during the freeze.
Oh, I see.
The administration nightmare still happens. The assets are still locked while the courts validate everything, and the financial cost of dying with assets in your personal name is staggering.
Right, the taxes.
Yeah. In Richard's case, owning a 78 million rand estate personally triggered massive estate duty. In South Africa, that tax is calculated at 20% on the first 30 million and 25% on everything above that.
So what was the final bill?
The Thompsons were suddenly facing 15 million rand in estate duty alone.
And looking at the sources here, the estate only had 4 million in liquid cash available.
This is exactly where families lose generational wealth. When you owe the taxman 15 million and you only have 4 million in cash, you are forced into fire sales.
Ouch.
The commercial property had to be auctioned off at a massive discount just to generate liquidity for SARS.
Unbelievable.
The business itself, which was already crippled by that 11-week freeze and the loss of key staff, it was sold to a competitor for a mere 8 million.
Practically giving it away.
It was less than half of its true operating value. And to make matters worse, the 3 adult children spent the next 18 months in a bitter legal dispute over whether to sell or keep the remaining assets.
So it tore the family apart, too.
Exactly. By the time the estate was finally settled nearly 4 years later, the widow received less than 30% of the original 78 million rand value. The wealth was just decimated.
Hearing that number less than 30% is just heartbreaking. I mean, it's 30 years of sacrifice wiped out by bureaucracy and taxes.
Yeah.
But the sources do give us the positive alternative. They detail the scenario of the Harrison family.
Right, the contrast.
William Harrison had a very similar setup to Richard, a manufacturing business doing $60 million a year. But 10 years before he died, he sat down with a trust consultant and established an inter vivos discretionary trust.
And just for anyone unfamiliar with the Latin there, inter vivos just means it is set up while you are still alive rather than waiting until your death.
Right, exactly. And when William passed away, the contrast was night and day.
The main difference was that the trust didn't die. A trust is a completely separate legal entity. It survives you.
Okay, let's unpack this.
When William passed, the trustees simply held a meeting the following week and confirmed operational continuity. The bank facilities remained entirely in place because the trust's credit relationship with the bank was completely unaffected by William's personal death.
So dying without a trust is basically like a company's CEO, CFO, and bank all vanishing on the very same day.
That's a great way to put it.
And with the trust, his wife had immediate access to funds from day one. No borrowing from relatives, no waiting 3 months on the master of the high court.
None of that?
And the tax implications are incredible because the trust owned the growth assets, not William personally. His estate duty dropped from a potential 18 million down to just 4 million.
Huge difference.
That is a 14 million rand saving. That's 14 million that stays inside the family structure to fund grandchildren's educations instead of disappearing into state coffers.
That is the true power of the Asset Protection Fortress. And this brings us right into the architecture of how a specialist like Limca Sturman actually designs these structures.
Right, the nuts and bolts.
The core philosophy she advocates is beautifully simple, but incredibly powerful. It's this. Your trust owns the assets. Your company carries the risk.
Okay, here's where it gets really interesting, but also a bit scary.
How so?
Well, if I'm looking at this structure, and legally, I am giving away my 60 million rand factory or my entire investment portfolio to a trust.
Yeah.
Legally, I don't own it anymore. I built that wealth. The idea that my signature is no longer the final word terrifies me. Don't I lose total control over my own life's work?
It is the single biggest psychological barrier for self-made individuals, but it's based on a misunderstanding of how control functions within a trust environment.
Okay, explain that.
You don't lose control, you change the nature of your control. You transition from being an individual owner to being a trustee, managing those assets for the benefit of the beneficiaries.
Which usually includes me, right?
Exactly. You, your spouse, your children. The sources highlight the Inter Vivos discretionary trust, specifically to address this fear of losing control.
So it's about separating the legal title from the economic benefit. Let me see if I can picture this. Is it a bit like putting a cake in the office fridge?
Okay, go on.
Like if I walk in holding my own personal cake, any creditor can come up to me and say, hey, you owe me, give me that cake.
Right.
But if I place it in the office fridge and it belongs to the company and the office manager, the trustee, hasn't cut a slice for anyone yet, no single employee's creditors can walk in and claim that cake because nobody legally owns a specific slice yet.
That is a brilliant way to visualize it. The discretionary element is the ultimate defense mechanism.
Because there's no fixed slice.
Right. Because there are no fixed entitlements, the trustees decide who gets what and when, based on the family's actual needs at any given time. If a beneficiary doesn't have a vested right to the asset, their creditors cannot attach it. If your business goes under and a supplier tries to sue you personally, those trust assets are completely shielded.
That's amazing.
It gets better. If your child gets married and later goes through a devastating divorce, their ex-spouse cannot claim half the trust's property portfolio because your child never owned it in the first place. They only had a potential interest at the trustee's discretion.
It really is a remarkable shield.
Mm-hmm.
But I do want to push back on the tax aspect for a second.
Sure.
Because trusts frequently get a bad rap for being heavily taxed in South Africa.
Yeah.
The sources lay out the numbers clearly here. Trusts face a 45% flat tax rate on retained income and an effective capital gains tax rate of 36%.
Yes, those are the numbers.
If I'm comparing that to my personal tax brackets, it sounds absolutely brutal. Why would anyone volunteer for those rates?
On the surface, those numbers do look punitive, but the key word there is retained income. To understand why it works this way, you have to look at the conduit principle in South African tax law.
Conduit principle.
Yeah. The trust acts like a pipe or a funnel rather than a bucket.
Okay.
If the trust earns income, say, rental yield from a commercial property, and the trustees distribute that income to the beneficiaries within the same tax year, the income flows through the trust.
Oh, I see.
It doesn't get taxed at that 45% flat rate. Instead, it is taxed in the hands of the beneficiary receiving it at their own personal marginal tax rate.
So it opens up this massive chessboard for tax strategy.
Exactly.
You can utilize the lower tax brackets of your various family members, like maybe a spouse earning less or adult children at university, distributing the income efficiently while still maintaining that ultimate 14 million Rand estate duty saving we talked about earlier.
Spot on. You get the protection of the corporate rate, but the flexibility of individual rates.
Okay, well, if the tax benefits and the asset protection rely so heavily on the trustees actively distributing income and making these nuanced decisions every year, the competence of those trustees becomes the single point of failure.
It absolutely does.
So who actually runs this fortress? Because if I'm putting all my life's work into this entity, I want to know how I prevent, say, a rogue family member from messing up the entire strategy.
Governance is where these structures either succeed or fail. The sources strongly recommend a combined approach. You absolutely need family members as trustees because an outside institution doesn't understand your family dynamics, your children's needs, or your business vision.
All right, they don't know you.
But in South Africa, for a family trust, it is actually a legal requirement to also appoint an independent professional trustee.
And people hate that requirement, don't they? They feel like it's interference.
They fight it constantly, not realizing it is their biggest safety net.
Mm-hmm.
Having an independent professional trustee, like an accountant, a lawyer, or a specialized trust consultant, provides essential objectivity.
Which you need when family is involved.
Let's be honest, families can be emotional, especially in the aftermath of a death or during a sibling conflict.
Mm-hmm.
The independent trustee is there to ensure the trust remains legally compliant with the Trust Property Control Act. They mediate disputes, they ensure proper resolutions are drafted, and crucially, they prevent the courts from looking at the trust down the line and saying, you know, this isn't a real trust, this is just a personal piggy bank.
Which is a perfect segue into the mistakes. Because you can hire architects to build the greatest fortress in the world, but if you leave the back door wide open, you're still going to get robbed.
Oh, exactly. What's fascinating here is how often people sabotage their own fortresses.
Right. Let's talk about how business owners do that. The sources outline a few major pitfalls. Mistake number 1, creating a trust, but never actually funding it.
Yes.
I'm imagining someone paying a lawyer to draft a beautiful trust deed, putting it in a desk drawer, and thinking they are immune to risk.
It happens all the time.
So setting up a trust, but never actually transferring your assets into it is like buying a state-of-the-art bank vault, bringing it home, but leaving your life savings on the kitchen counter next to it. It provides zero protection.
That happens more often than you would believe. An empty trust is just an expensive piece of paper.
Yeah.
You have to legally execute the transfer of shares, physically do the conveyancing of properties at the deeds office, and formally move the investment portfolios.
It's actual work.
Right. And mistake number 2 is equally dangerous, treating the fully funded trust like a personal bank account.
Like the piggy bank you mentioned.
Exactly.
Right.
This is where a founder mixes personal and trust finances. They buy a sports car in the trust's name, but only they drive it. Or they pay for their weekly groceries out of the trust account without any proper trustee resolutions or loan accounts in place.
And if a creditor catches wind of that,
The creditor will go straight to the high court and ask the judge to pierce the trust veil.
pierce the veil.
Wow.
Yeah. If the court sees that you've been treating the trust assets exactly as if they were your personal property, they will declare the separation of control a sham. The protection dissolves, and the creditors take the assets. That is a terrifying consequence for sloppy admin. But there's another mistake in the sources that feels a bit more insidious. Mistake 4, ignoring Section 7C.
Section 7C.
I've heard this term thrown around in business circles, and it sounds highly technical, but apparently it is catching a massive amount of people out right now. What is the actual mechanism here? Why did SARS introduce this?
To understand Section 7C, you have to look at the loophole wealthy families were exploiting before 2017.
Okay.
People would sell their highly valuable growth assets to their trust to get them out of their personal estate. But instead of the trust actually paying for the asset, because trusts rarely have cash on day one, the creator would just give the trust a massive interest-free loan for the purchase price.
Oh, wow. So it's essentially a phantom transaction.
Exactly.
It froze the value of the estate in their personal name at the loan amount while shifting all the future growth of that asset into the trust, effectively bypassing estate duty entirely.
Precisely. SARS realized they were bleeding massive amounts of tax revenue through this loophole, so they introduced Section 7C.
And what does it do?
Now, if you give an interest-free or low-interest loan to a trust, SARS looks at the interest you should have charged based on the official rate, and they treat that missing interest as an ongoing annual deemed donation.
A deemed donation.
Yes. And donations in South Africa are taxed at 20%. So if you aren't managing those loan accounts correctly, or utilizing your annual 100,000 Rand donations exemption strategically, you are quietly building up a massive silent tax liability that will hit your family hard.
This highlights exactly why downloading a generic, off-the-shelf trust template from the internet is a recipe for disaster.
Absolutely.
The rules change. The tax laws evolve. You need a living, breathing strategy. But beyond the cold mechanics of tax law, we have to remember the human element at the center of all this. Trusts ultimately protect people, not just balance sheets.
That is the most profound benefit. A well-drafted discretionary trust deed accommodates the incredibly diverse realities of your beneficiaries.
The sources use the example of the Chen family, which I found incredibly illuminating.
It's a great example.
The parents have 3 kids in vastly different life stages. You've got a 32-year-old who is married, stable, and working. You have a 28-year-old in the middle of a grueling medical residency just drowning in debt, and you have a 19-year-old just starting university.
Right.
If the parents pass away and just leave a lump sum through a basic will, the law mandates a rigid, equal split. It's a blind distribution of cash.
But the trust allows for intelligent, tailored support. The trustees can look at the actual landscape.
Yeah.
They can fully fund the 19-year-old's tuition and accommodation. They can provide a monthly stipend to the 28-year-old to help with living expenses while she finishes her medical training.
That makes so much more sense.
And they might decide to distribute a specific capital amount to the 32-year-old to use as a deposit on a house. It replaces the rigid rules of inheritance with flexible, fair, and highly customized care.
It's giving your family what they need when they need it. But achieving that level of customization requires serious, deliberate planning, which naturally brings up the practical side. The costs.
Yeah, if I'm listening to this, I'm wondering what it actually takes to execute. I'm looking at the sources, and building this fortress properly isn't just a matter of paying a 500 Rand filing fee.
Definitely not.
The initial setup for a comprehensive trust and company structure can range anywhere from 80,000 to 250,000 Rand, depending on the complexity of the assets.
Right.
Then there's ongoing annual maintenance, accounting, tax filing, independent trustee fees, which might run another 20,000 to 50,000 Rand a year.
That's a fair estimate.
So, what does this all mean for the listener today? Spending up to $250,000 up front and maybe $50,000 a year sounds like a massive overhead for a small business owner. Is the ROI really there?
You have to measure the cost of planning against the catastrophic cost of inaction.
Go back to Richard Thompson. Because he wanted to save a few thousand rand in structuring fees during his life, his family lost between 30 and 50% of a 78 million rand business and paid 15 million in completely avoidable taxes.
When you put it like that.
The sources break down a very clear conceptual cost-benefit analysis. An investment of roughly 600,000 rand in setup and professional maintenance spread over 15 years can realistically protect 28 million or more in family wealth.
Oh.
The ROI is astronomical, but you only realize that return if the structure is legally watertight from day one, which is why working with a specialized trust consultant like Lumka Sturman is vital. Generic templates fail when you need them most.
Which brings us back to her methodology. How does a business owner actually start this process without just walking into a corporate law firm and signing a blank check?
Good question.
What I appreciate about her approach in the sources is that she breaks it down into logical phases rather than an overwhelming legal maze. It's all about clarity and education.
It is a phenomenal way to approach fiduciary planning because it forces the client to understand their own risk before spending money on structures.
Right. Conceptually, she starts with a foundation audit. Looking at the guide here, it's about 25,970 rand. And instead of just registering a trust blindly, this phase is an exposure risk analysis.
Exactly.
She looks at how your personal assets intertwine with your business liabilities. It answers the fundamental question: are you currently exposed? And if so, what specific walls need to be built?
It's perfect for new business owners.
Yeah, it's like mapping the terrain and identifying the vulnerabilities before you even draw up the castle plans.
You shouldn't lay a single brick of your fortress until you know exactly where the attacks will come from.
From there, once the risks are mapped, you move to the asset protection blueprint. That one is 39,990 rand. This is the step-by-step custom mapping of your unique trust and company structure.
Right, the actual plan.
It shows exactly how the assets will flow from your personal name into the trust, provides the exact document checklists, and ensures you have total guidance on staying compliant with SARS during the transfer.
Which is crucial.
And then, importantly, there's the annual maintenance package for 47,900.
This is the phase that prevents everything we talk about with Mistake 2.
Yes. The annual trust resolutions, the SARS compliance, the beneficiary updates. It's an annual Fortress checkup to detect any red flags, ensuring that if a creditor or the taxman ever knocks on the door, the courts look at your structure and say, this is a legitimate, compliant trust.
Exactly.
Luminska's mission is all about clarity, education, and empowering South African entrepreneurs. If you are generating income and building assets in South Africa, you owe it to your family to explore this protection.
Absolutely.
You can learn more about this phased approach and book a confidential risk assessment by visiting her website at www.lumcasterarmand.com. It is simply about taking that first educated step before the unexpected happens.
It really requires a fundamental shift in mindset, you know? Your business, your daily grind, that protects your income for today. But a legally sound trust structure protects your wealth for tomorrow.
That's true.
Working with an educator and specialist bridges the massive gap between complex legal theory and practical, real-world survival for your family.
Let's bring all these threads together. Setting up a trust in South Africa is not about hiding your money in the shadows. It's not some shady offshore tax evasion scheme for billionaires.
Not at all.
It is an act of profound love. It is an act of deep generational responsibility. It's about ensuring that the business you sacrificed your life to build, the wealth you accumulated brick by brick, continues to serve its purpose.
Right?
It's about shielding the people you love most from the agonizing grief of financial chaos, from years of bitter legal battles, and from massive, entirely unnecessary tax burdens. It is about keeping the heavy iron gates of your fortress locked tight against risk, but leaving the doors wide open for your family's future.
And that leaves us with a final concept to consider. We've talked a lot today about using trusts to protect wealth from the outside world, but consider how a trust protects wealth from within.
Oh, interesting.
We spend our entire adult lives obsessing over how to generate wealth, but spend almost no time thinking about how to transition it. Ask yourself, if you were to step away from your business tomorrow, permanently, would your family inherit a financial fortress or a financial prison.
Wow.
The choice of what you leave behind is entirely up to the structures you build today. What if the greatest gift you can leave your children isn't a massive lump sum of cash, but rather the structure that dictates how they interact with that wealth?
That's a great point.
A trust doesn't just transition money, it transitions values. It requires heirs to collaborate, to justify their needs to trustees, and to view the family wealth as a shared legacy rather than an individual lottery ticket.
What an incredible perspective. Are you leaving them a fortune that might ruin them or a structure that will sustain them? That is a powerful thought to take away. Don't leave your life's work exposed to chance. Build the fortress. Thank you so much for joining us on this deep dive. Keep learning, stay curious, and we'll catch you on the next one.